Welcome back, investors, to Ticker Time News. I'm Adam, and the stock market saw some turbulent price action today after the release of the hot June CPI data. At the start, the three main indices headed downward before recovering a small portion of their losses after a Wall Street Journal report from a, quote, Fed insider noted that the Fed is likely to increase the Fed funds rate by 75 basis points in July. Well, we know that. That's what they said they were going to do. But there was this growing concern in the financial district that there would be a 100 basis point increase. And that got all the analysts scared and nervous in the market today. And, well, that's why there was a bit of upward momentum today. But that upward momentum, it really didn't stick. And the market dipped before the close. The S&P 500 and the NASDAQ both closed a few points below their weekly expected move. With this, we're likely to see the markets continue to be choppy and hang around their weekly expected move. This type of market, unfortunately, this choppiness in the market is one of the hardest markets to trade in. And honestly, patience is the key to the whole game. Now, before I go any further, let's look at the S&P 500 here and try to digest a little bit of what happened today and talk about this. Well, we are right at price action, that is, where we closed today at 38.01. It's right about the weekly expected move, right? Maybe 10 points below that. Okay, that happens. But usually, when a stock or Bitcoin or any type of equity or crypto that you're trading, when you have these weekly expected moves, there's a 2/3 chance that the price action will stay within it. And there's only a 1/3 chance that it will move outside of it. Now, when it moves outside of it, a lot of times it will come right back in. So let's use this. Let's go to the 15-minute chart here, and you can see what I'm talking about here. This is today, right here on the middle of the screen. We'll make it a little bit bigger here. All right. So this morning we had, and real quick, let me get my marker. This morning we had this drop off right here, right? And that was from the CPI report. And it was bad, right? It came in hot. However, a lot of investors think that this is peak. This is where inflation will peak. And we've been talking about this now for a couple of weeks. If we look at commodity, if we look at the copper and gold ratio, we can see that there is an economic slowdown, right? Commodity prices down. Oil, right? Part of commodity. Oil has been trading much, much lower. CPI is a lagging indicator, meaning it's not reporting on what's happening right now. It's reporting on what has happened in the past, right? We all understand that. We get it. So when it comes out with a hot number like this, and we know that commodity prices at least have come down, and everything else that I just mentioned, then we could probably forecast that maybe next month or the month after that, probably within the third quarter, more likely, we could actually see inflation start to maybe inflect down a little bit, right? Maybe we can see that arch of inflation start to curl over and come down. That's a possibility. So if we are at peak inflation, then that's a good thing for the markets. Because if inflation starts coming back down and it's under control, right, that means the Fed doesn't have to raise rates for the Fed fund rate. And if the Fed doesn't have to raise rates, then the stock market can go up, right? A Fed pivot, that is a key moment when the Fed has a policy directive and then they pivot and turn to a different policy directive. That's what we would see if inflation starts to come down and the Fed doesn't have to raise rates. We could see a Fed pivot, right? We're not going to see it here in July. No, the inflation reading was too high right now. However, September, that may be October even, that may be a good time for a Fed pivot because maybe inflation is coming down and the Fed does not want to continue to tighten or raise rates when we're going into a potential recession or an economic slowdown, because that would just make matters worse. So a couple thoughts there on what happened today, why we had the dip in the morning because inflation was bad, but then why we had this rally throughout the rest of the day, right? For most of the day. And if you notice, and I'll highlight it right here, we came up and tagged the weekly expected move, the bottom end of that. And then we broke above it, came right back down to it, broke above it, came back down to it, and then we closed slightly outside of that weekly expected move. It really acts like a magnet, just like moving averages do, okay? So that's why we're seeing the price action that we saw today. If you had puts this morning, were able to close them, then you did a good job. And I'm sure you got something out of it, maybe not as much as you were hoping for. We're in a little bit of a different situation than we were a month ago. A month ago, I don't think many were thinking peak inflation at that point in time because commodity prices had barely started to come down. But now we're kind of seeing the full picture here that, yeah, maybe the peak inflation narrative, maybe that could be right at this moment in time. But we'll have to wait and see for more on that. Market was dumb. Yeah, it was. Absolutely. That 100 basis point gibberish, I don't know where that came from because I hadn't seen it in anything that I read. But then you have this article come out, says, hey, people were worried. They were scared of a 100 basis point rate hike. But don't worry, the Fed's going to do 75 because that's what they said they're going to do. And that's what calms the market and causes it to rally some. Oh, boy. That's why I said earlier that this is the hardest time to be a trader right now, because this choppiness, the market can swing from one direction to another without any real rationale to it, right? Oh boy. So this morning here, there was a bit of seller conviction early on, right? Because of the CPI report. And that conviction this morning, decliners led advancers by a 6-1 margin at the New York Stock Exchange and a 3-1 margin at the NASDAQ. And then the advanced decline line showed mixed interest at the close. Decliners led advancers by roughly 11 to 10 margin at both the New York Stock Exchange and the NASDAQ. Then we got to talk about the mega cap stocks because they did their duty today. Any thoughts on apps? Yeah, I'll pull that up real quick here and then we'll go look at the mega caps. All right. Let's load them here. All right, I'm going to go back to the daily view here and look at Digital Turbine. It has had a hard fall. Okay, so first thing I notice here on the chart here for Digital Turbine is it looks like it is trying to build a base, right? And that's a good thing. And that base is, right down here, somewhere around the 15 up to $16 a share range. That's a positive development because it's a good potential that we could see some sort of a move to the upside if it's building this base throughout the summer. Once we get into late August, September, October, I don't think the market's going to fare too well. Plus, we've got this earnings miss right here. Let's see how bad it was. Oh, let me get the cursor back. There we go. Okay, so basically in line with the EPS, but they missed on revenue quite substantially at 38%. So it seems like they were making money with their money. They just weren't making enough money. Yeah, big choppiness up here when this would be September of 21. Was that its high? Oh, maybe it hit its high a little bit earlier. All right, so we got a very strong line of support. If it gets back up to it, it'll probably turn into resistance somewhere around that $50 line. But I don't see this getting up to $50 anytime soon. Okay, this is going to take a while. And there's probably going to be another leg down, even though it's building this base right now. A lot of the market is building a base somewhat. We've got bearish pennants. We've got symmetrical triangles. We've got ascending triangles. There are all kinds of bearish chart patterns out there right now on these different companies. And if we want to look at this, I mean, we could probably, even though it's kind of spread out a bit, if I were to try to draw a trend line, it would probably look like this, descending, and then from the bottom up right here, and that's ascending. And there we go. Now we've got a symmetrical triangle look there, or a wedge at the very least, but this is probably just going to end up being a continuation pattern that once price begins to really start to tighten, you have a likelihood that it's either going to, break to the upside or it's going to break to the downside. And a late summer rally, it's not that far out there, but it will not last, right? You get these bear market rallies, like there was this bear market rally here. You had a little one right there. The biggest, bear market rally was back here at the end of March, just above my head there. So you can get these bear market rallies, including, this most recent one there. And that's what we'd probably be looking for. You could probably get another bear market rally out of this, but then, it's going to come back down as we get into September and October of this year. The market's going to be real rough. So even though it is building a base right here, that base I don't think is going to last very long. So just a couple thoughts there. All right. So there's a couple thoughts there. Technical analysis for apps. Digital Turbine, nice 2.3% move up today. I must give them that. And 1.2% here in the after hours. That's also a pretty big move. And there's no specific news here in TradingView, but that doesn't mean that there's not. Okay. So there's some thoughts there on apps. All right. Let's just check. It's our lucky day, huh? I think that on Twitch, huh? That looks a bit spammy to me. Have a good broadcast. Tired of advertising? We will help. Okay. Yeah, that seems a bit spammy. Doing that during a live stream, although it looks like it's coming from Twitch, and I'm not too familiar with the rules on Twitch just yet. But yeah, okay. Let's keep moving on. The mega caps, they pulled their weight today and they outperformed the broader market. We got the Vanguard Mega Cap Growth ETF. Ticker symbol is MGK. We'll pull that up here and compare how they did, because this is always your sign of how the market is going to do, because mega caps can either lift the markets up with them or they can push the markets down with them. So it's always good to track the mega caps here. So down 0.25% today, not too bad. Another 0.25% after hours, but they pulled their weight, definitely. And they closed ahead. They closed ahead of the broader market. Up here on the right hand side, you can see SPX that was down 0.45%. Vanguard Mega Cap ETF down 0.25%. So better than the S&P 500. So they help to keep the S&P 500 from going even lower today. And then we compare this to the Invesco S&P 500 equal weight ETF and see how that was down. Ticker symbol is RSP. And remember, you can follow along at home. There's a link in the description of this video to TradingView. Click on it. You can sign up for a free account, and you'll be good to go. And you can follow right along at home. Okay, so today this was down 0.5%, right? So much better. Mega caps did much better than equal weight here. And you can see equal weight even filled in this gap. So I can actually go ahead and take that gap here off, because that was filled. All right. Okay. Let's also talk about semiconductors here for a moment. The iShares Semiconductor Index, and I don't usually talk about this one, but it's SOX and another X, and that gets you there. It is part of the NASDAQ. It has held up pretty darn well. It was up 0.5% today, which is really, really good. It is using its 21-day moving average here as resistance. And you can see that it's kind of moving along like this right there. So it's using it as resistance there. But that's a good thing. There's this big channel that it has been in. Looking at a top here around 440, 441, and then the bottom being around 225. But right now, it is using that 21-day moving average as resistance, but it is still up about 8.4% from its early July lows, which are right down here. That's a good move for semiconductors. And then we can compare this, and let me just clean that up a little bit. We can compare this to our typical semiconductor index that we look at, and that's the Philadelphia Semiconductor Index, and the ticker symbol is SOX, just one X there. You use the one from NASDAQ. You can also use the one from TVC as well. They both work out. So when we look here, the same thing is happening, and it should, because they are all tracking semiconductor companies. So we've got this 21-day moving average there acting as resistance. And of course, it's up 0.75% today, and it's up about 8% from its early July lows set right back here. And that would have been on July the 5th, first day of a short trading week there. Okay, so semiconductors are looking pretty good, but there is that resistance that they are running into right now, and that's going to keep a lid from them really exploding up. So if you want to be bullish on semiconductors, you really need to see this make a move up above that 21-day moving average and then close above it. That would be the best thing for semiconductors. Otherwise, it's just going to keep bumping its head along this 21-day moving average. Okay. All right, let's talk about the sectors right quick. Lower this down, get them all in there. Surprisingly, energy didn't do so bad today. Energy has just been very volatile, and its first half of the year gains are, are starting to get wiped out a little bit. So let's talk about this. On the right-hand side of the screen here, you can see at the very top, there were only 2 sectors that were in the green. Only 2 of the 11 S&P 500 sectors closed in the green. Consumer discretionary up 0.9% and consumer staples up 0.1%. Now, the other sectors showed losses ranging from down 0.1%, which was energy, to down 1.2%, which was industrials. So a lot of red there, but really not a lot of movement except for, communication services down 1%. And then, of course, we've got industrials down 1.2%. Those were the hardest hit. Everything else under 1%, and not too bad. It was a rather flat day here when we look at this. Even the winners today, up 0.1%, up 0.8%. Not that great either way. And again, going back to the beginning, this is a very challenging market because of the choppiness, right? The indirection. Investors, traders, they're not sure which way to go. Should I, go long on this one? Should I short that one? It's very difficult, and we can just see it in all of the data that we're getting. You are welcome. Falling knife, but their forward PE is 9.97 now. Yeah. No, PPI, not yet. That gets reported tomorrow, and I've got the expectations written down for that one too. Okay, there's not a lot left for what I wanted to talk about here today, but just real quick, I do want to run through these couple of things. Number one, Netflix, NFLX. Netflix has been looking for a company to help them with advertising, right? Netflix wants to do a tier that is ad supported, right? Well, we know that Netflix has been talking to Comcast. We know they've been talking to Roku and also Microsoft. They've been talking, trying to get bids. Who will fit best, and how can we get this done? Well, Netflix was up 1.2% today. Twitter's another one that I want to talk about. They were up 7.8%. And then I also want to talk about Iron Source. They were up 47% today. All of them made big moves off of big news catalyst, right? Okay, so Netflix chose Microsoft for its ad-supported subscription plan. Now, this is a big hit to Roku, because I was on the side that I was thinking Roku might have a good chance at this, and it would really, really help Roku, turn things around for them. But unfortunately, that didn't work out. And again, I really thought Roku would have fit good here, but Netflix chose differently. So Microsoft is it. They are the one who won the day with working with Netflix to create that ad-supported tier lower, right? We'll see how that works out. All right, Twitter, let's pull that one up. TWTR, this one is so wishy-washy in the news. Every headline will shake it. Up 7.9% today. Why? Well, Twitter was up after it was reported that Twitter filed a lawsuit against Elon Musk to enforce the merger agreement. And then we have Twitter's CEO sending an email to Twitter employees with the subject line, quote, Musk litigation. And he also says that the current environment, macroeconomic, geopolitical, societal, they all present additional complexities and challenges for Twitter and its industry. Well, we'll see how that works out for you, Twitter. This is a saga that will not go away anytime soon. What do you think? Is Elon Musk playing a 4D chess here? Is he trying to get a lower bid here, a better deal, or is he really just fed up with it and walking away? Let me know your thoughts. I'm curious. So that's Twitter. Now, Iron Source. Yes, Iron Source. It surged today after Unity, and we'll look at Unity right here real quick. After Unity Software confirmed a merger agreement. Now, Unity was down 17.4% today. Nearly 17.5% today, because it's going to merge with Iron Source. Now, Unity, for its part, had a big sell-off here. But Iron Source, which is such an odd name. See, Unity is a company for the future, right? It's a company for the metaverse, gaming company. I think it's a good company to bet on long term. I think Unity is one that's going to be there. But right now, and this is why it lost over 17.5% today, in thinking business sense, right? This is not the best time to go buying companies unless you think their valuation is rock bottom, right? And I'll add to that during good times, you made your balance sheet rock solid, okay? Because we talked about this months ago, that in business, when you have a company, during good times, that's not when you purchase other companies. That's not when you merge. That's when you build up your balance sheet. Because during the hard times, when the valuations have come down and every other company is hurting out there, you can buy that company at a discount instead of paying a premium. So it's smart for Unity, as long as their balance sheet is solid, to make this merger now, right? It's good. I might have waited a little bit if I was running things, but again, I don't know the details, so I can't say whether it's a good deal or not. But we'll find out eventually. That information will come out. Okay, oil prices, they have been so volatile lately. US, OIL, all over the place. However, there is a silver lining here, and that's where you see these highlighted marks. Oil, for its part, it was down 0.5% today, right? And it settled at let's see, 90. It settled at $96 a share. It is now down to $95.8 not a share, per barrel, excuse me. So it's down a little bit more in the after hours. There is a strong line of support at that $95 a barrel for oil. And it also coincides, its 200-day moving average is also moving up here like that. That's a second degree of support for oil right there to hang out and bounce off of. So we do have that as a silver lining as oil continues to come down. Now, of course, this does affect the energy sector. As oil comes down, so does the energy sector. So we'll see how this continues to move. We also have natural gas. It went the opposite direction. It rose 9% today, back up to $6.50 per British thermal unit. Unleaded gasoline fell 0.5% to 3.24 a gallon. And then we get the 210 spread. It became even more inverted today, right? Look at this, US 02Y. The 2-year yield rose 10 basis points to 3.13%. It is up even more here in the after hours. What did the 10-year do? The 10-year fell. The 2-year rose today, and the 10-year fell 5 basis points to 2.9%. US 10Y for the 10-year. And then you can divide the 10 and the 2-year to get your 210 spread. But it was down. It was down while the 3-year rose. You know, that bonds are telling us something. They are telling us something about the economy. There's no way a 2-year should reward you more than a longer term 10-year, right? Okay, now tomorrow at the open, we've got JP Morgan, ticker symbol JPM, Morgan Stanley, ticker symbol MS. We've got Taiwan Semi, ticker symbol TSM. All of them are set to report earnings. These big banks will drive emotion in the market tomorrow morning, okay? So be prepared for that. Tomorrow morning could be more chop, right? More chop tomorrow, all because of the big banks reporting. So we've got that to watch out for tomorrow as we're moving. Now, also tomorrow, we get the June PPI, which is the producer price index. So today, we got the CPI, which is the consumer price index. What do consumers pay? The producer price index is on the producer level. What are their input costs, right? The expectation is 0.9%. Last month, it was 0.8%. Now, core PPI is expected to remain the same, 0.5%. That will be interesting to watch for tomorrow. That too will play a big role in how the market is going to handle price action, right? So much info, isn't it? It is. It's just a ton out there, and it all plays a role in how this market moves, which is why it's so choppy right now, and that's what makes it so much more difficult. Now, on top of the big banks reporting tomorrow, on top of the producer price index, we also get weekly initial jobless claims. The expectation is 239,000. The prior was 235,000. So a slightly bigger loss there, you could say. And then continuing jobless claims, they come out as well. All of this is at 8:30 in the morning. It's going to be another weird day in the market for sure. Now, today was a very heavy day for economic data. We got CPI, total CPI increased 1.3% month over month in June. The expectation was 1.1%. So we got 0.2% higher prices after increasing 1% in May. Now, core CPI, which you take out food, you take out energy, that increased by 0.7% month over month in June. The expectation was 0.6% after increasing 0.6% in May. So it just got worse. Now, on a year-over-year basis, total CPI was up 9.1% versus 8.6% in May. That's a big jump. That leaked CPI data from yesterday being at 10.1%. It wasn't far off. It wasn't far off at all. But that's what sank the market yesterday, which I think played in a bit to how this market rebounded a little bit today, because it kind of got oversold yesterday because of that fake news. All right, core CPI today was up 5.9% versus 6% in May, down slightly. So the key takeaway from the CPI report is that inflation pressures, they remain broad-based and elevated even when accounting for the slight dip in the year-over-year core inflation rate. Meanwhile, total CPI accelerated to 9.1% year-over-year, representing the fastest rate of increase since late 1981. I was just a baby at that time. 1981. Fastest rate since then. We also got the weekly MBA mortgage applications. That was a negative 1.7%. I expect that to continue to be negative. Last week, it was down 5.4%. Then we got the Fed's June beige book. Yeah, the beige book. And it described overall economic expansion since May as modest, with several districts, reporting signs of a slowdown and growing fears of a recession in a few other districts. Consumer spending moderated, while auto sales remained weak due to low inventories. Hospitality and tourism, they saw healthy activity, while manufacturing was mixed. The employment situation rose at a, quote, modest to moderate pace, and wages continued growing in most districts. Now, substantial price increases were reported across the board. Those are the most important points from the beige book. And that brings me to everything I wanted to talk about today. So if you have a question, let me know in the comments. And while you're doing that, please do me a favor, click that like button, share this video, and if you're new, click subscribe. Those three things are very helpful to a small channel like this. And if you like this perspective and you want more, then click the first link in the description and check out what we have for investors over on Patreon. It is a ton of information, and I hope it's broken down in such a way that it's easy to digest. All right, where did the market like the oil numbers released today? You know, I had that. Let me go ahead and pull that up. I actually took it out of today. I was going to talk about it, but I chose not to. I didn't think... let's see here. Where am I going? There we go. Everything's so much bigger here on the big screen. I'm not used to that. All right, let me open up to those oil reports and those numbers. Quite honestly, with all of the other data that came out today, those numbers were probably the least interested. But here we go. We also got the Treasury budget too today. So crude oil inventories had a build of 3.25 million barrels. Prior week showed a build of 8.24 million barrels. So on the crude oil inventory, we're down substantially, nearly 5 million barrels. And then gasoline inventory what was that at? So that was at 5.83 million barrels. And then the prior week showed 2.5 million barrels. So crude oil inventory dropped by 5 million or so barrels. And then gasoline inventories, they increased by about 3 million barrels. And then we had the Treasury budget that also came out today with an $88.8 billion deficit in June versus a $174.16 billion deficit in the same period a year ago. The budget data is not seasonally adjusted, so you can't necessarily compare it directly as like an apple and apple comparison to the June deficit compared to the May deficit a year ago. So just keep that in mind. And a year ago, I think it was about 66.2 or so billion. So we have that in there as well. So on those two fronts, the oil numbers, the Treasury, I don't think the market really heard it, right? With all of the other noise in the market today, CPI being the biggest one, I really don't think the market paid attention to what the oil inventories were. That's what I think. That's what I think. Okay, just real quick here, I just want to talk about chart patterns, just to give you guys a second if you have any other questions. Volume was low, okay? If I move this chart up a little bit, you can see it down here. Volume was way below average, although I will give it that we had been decreasing pretty sharply down here with volume, but now we've kind of plateaued and we're moving sideways. But that is still way below where volume should be, okay? All right, so let's fix the chart. And then I'm going to take volume off just for a moment here. Okay, so now we can see the chart a little bit better. We've got a bearish pennant set up here, right? However, with this pennant, it did break the support line at the bottom, okay? So expansion leads to contraction, contraction leads to expansion. So here's how we look at it. We had expansion right here, right? And then we get the end of May all the way over to the beginning of June. That's contraction. And then we get a real big expansion all the way down to the middle of June. And now we are starting to contract in price action, okay? This contraction will lead to expansion. What side will this go? Well, this is a bearish pennant chart pattern here in front of you. That's what the, excuse me, take that away. That's what the dotted red line and dotted blue line are indicating, right? So with this, as price continues to chop around, right, inside of that chart pattern, we should at some point, even though it broke low today, it's a potential that we could see price action kind of move sideways here, right along its weekly expected move. And, you know, quite frankly, we only have 2 sessions left this week. So it's not that far out of the realm of possibility that we just continue to chop around. That's the 14th there. And then there's the 15th, and then the week's over. And then we get a new trading range for next week because the options market will tell us where they think price will go. And remember, the options market is right 2/3 of the time, right? That's one way to say it. You can also say, 68% of the time, which is a little less than 2/3, but it's right around there. 2/3 accurate. So that's what I would expect for the S&P 500. That's what I would expect for the SPY, is choppy movement sideways. That's it. Nothing else there, because I don't think there really is. I don't see any big movement. There wasn't big movement today from the scary 9.1% inflation rate. Now, I know there's going to be a lot of headlines, and a lot of consumers are going to say, what in the world? Inflation is that high? No way, right? So the consumer is going to be in shock, but I think the trader, we're expecting these high prices. But we're also expecting inflation to peak because commodity prices have been dropping. So maybe we're a little ahead of the curve. That could be, right? That's a potential. Now, if we look at the oscillators, the RSI, MACD, they are starting to roll over, right? They're starting to curve over and come back down. So momentum is dropping, which is why I think it's a real possibility we just chop around sideways for the next two sessions and end up closing somewhere around the bottom of the weekly expected range. So if we look at the SPY right quick, the weekly expected move on the bottom is 178, right where we are right now. On Twitch, you should change the category to stocks and bonds. Okay, thank you for letting me know. I didn't realize that. I'm still learning Twitch, so I definitely don't have Twitch figured out. But thank you for that. As a matter of fact, I'm going to write that down right now so I don't forget that. Okay, got that. I'll try to take a peek of that tonight and get that changed. Thank you for pointing that out. I do appreciate that. Okay, so here we are. We got 178 as the bottom of the weekly expected move for the SPY, and it's sitting right on that right now. I just expect more choppiness, sideways motion. Again, RSI, MACD, they're rolling over. They're losing momentum, which tells me we're just going to stay put. If we look at the NASDAQ right quick and see how tech is handling it, they're doing a little bit better, okay? But they still have a bearish pennant as a chart pattern. But they are making really good strides here for higher lows, right? We had our low set back here in June, and then a higher low and a higher low even today. So that's looking pretty darn good, except for the fact the top here, it's just hanging on flat, right? It gets up to that resistance, can't finish filling that gap, and it just stays there. And it too is sitting right on the bottom of its weekly expected move. And that's sitting at 11,728. 11,728. And that's exactly where it closed today. So, I mean, it's just sitting right there. If you look at the Qs Oh, thank you so much. I greatly appreciate that. And we're not far off. Maryland, I'm in Northern Virginia here. All right, so we look at the Qs, same thing. We've got making higher lows, right? But the top here on this bearish pennant is flat. It's not going anywhere up top. It hits that resistance and cannot fill that gap. So we've got the expansion, right? Boom down, and now we are contracting in price. We'll probably just continue to move sideways. For the Qs also, our weekly expected move is 286, and we're at 285, so we are just below that weekly expected move. And remember, 2/3 of the time, we end trading for the week right here within the weekly expected move. And we are sitting right on the bottom of that right now with 2 trading days left. All right. So that's a wrap here for today. I greatly appreciate you spending your time here. Remember, click that like button and share this video. Those are 2 things that can help out the channel greatly. Oh, I did want to mention Bitcoin. I totally forgot about that. The chart pattern here for Bitcoin is a bearish rectangle. Now, there is a story going around that over 100,000, like 130 or 120 thousand Bitcoins could potentially be released into the market this August. And this is a wild story. It dates back several years ago, where a Bitcoin or a cryptocurrency exchange, one of the first of its kind, went bankrupt and nobody could withdraw their money. Well, just now, a court has ruled and a fund has been set up to start giving people their money back. Now, most of these individuals who are getting, their Bitcoin back, are they going to sell or are they not going to sell? If you've been holding that Bitcoin for that many years, you know the cycle that Bitcoin goes through. So would they sell Bitcoin here close to a bottom, or would they hold it and wait a couple of years for Bitcoin to get back to an all-time high? That's the question, right? Are they going to sell it or are they going to hold it? So it's like 120 to 130,000 Bitcoins that can be released potentially all at once or a little at a time starting in August. And that could drive Bitcoin's price down lower. I totally forgot about this and I totally wanted to mention it. And we got this bearish rectangle happening right here. Basically, Bitcoin is moving sideways in this zone. If the report is true about this, then my area here that goes down to about 16,000 or so dollars here, from 20,000 to 16,000, Bitcoin could get that low. It could even potentially drop a little bit lower than that if those Bitcoins are released all at once and they are sold all at once, because that's a big chunk of Bitcoin. All right. So just want to throw that out there. That happens in March. I'm sorry, August. That happens in August. And that could be a really good buying opportunity for Bitcoin. I just want to throw that out there. Ethereum is also trading in the exact same way, sideways. It's a bearish rectangle. And both of them did really good today. Bitcoin up 4.7, Ethereum up 7.5%. Both really good. All right. So, thoughts on banks, bank earnings. I think earnings for the banks are going to be good. I think their actual earnings, their EPS and revenue, I think is going to be good. What I'm watching out for or listening for from these big banks is how much are they setting aside for defaults? That's what I'm looking for. If you look at Upstart, right? Not a bank, right? But they do loans. Upstart's hurting right now. They're trying to get loans off of their balance sheet and replace those loans with cash. So they're trying to sell their loans to other investors or banks. The problem is not a lot of banks are buying those loans. That tells me that they are setting up for much bigger defaults. Because if we go into a recession, and I think we're already in one right now, but if we go deeper into a recession where unemployment, which is one of the key indicators for recession, which right now is strong but peaking, if that continues, if that number continues to rise, meaning people are losing their jobs, then there's going to be more defaults. That's one of the big key things that I'm watching for with these big banks. Okay. Also, I'm watching for their credit, right? How strict are they getting with lending, right? So two things there that I'm looking for. I think earnings will be fine. I think everything has been okay up to this point. But as we get into the next couple of quarters, maybe the next 3 or 4 quarters, that's when it could start to get dicey for the banks. Because right now, loans are still flowing. Right now, people are still paying their loans. Consumers are going through their savings account. Consumers are dipping into their, excuse me, I got a phone call. That's odd. I typically don't get those during a live stream. But what was I saying? I lost my train of thought. So yeah, that's the two things I'm looking for. Consumers, they're starting to tap into credit to pay for things, and that's not a good sign for banks and for lenders. So that's the big two things I'm watching for right now. So that's my thoughts on the big banks. And if you can look at the stock chart here, I mean, Morgan Stanley, one of the biggest, most secure banks out there. I mean, they're a fortress, has been selling off, which to me, there's just so many juicy buying opportunities that are right in front of us. We just got to wait for those signals that say, hey, we're at some sort of a bottom here. And as long as there's growth concerns, we're not going to be at a bottom. So this earnings season, remember, is phase 2 of the bear market. There are going to be a lot of earnings that come out, and their forecasts are going to be reduced. And that is what will send the market down lower. At least that's what my theory says. You are welcome. Also, futures are taking a bit of a hit right now. Yeah, it's going to be choppy. It's going to be really choppy. And I can't imagine right now right now, I just can't see a big move either way. Right now, investors who do not pay attention to the market, they are right now hearing about the CPI report, right? And they may be calling into their brokers, hey, inflation was high. Maybe it's time to change things up a little bit. Oil has been dropping. Energy is getting weaker. Should we, rotate to a different sector? And remember, this is what happened during last month's CPI. All right. This candle right here was the day before last month's CPI report. This was the candle for CPI report, And this was the big gap down and candle the day after the CPI report. This big drop was during last month's reporting of the CPI and PPI data. Could we do something similar? Well, it won't be similar because we didn't fall that much today. But tomorrow, we could go down to the gap. We could go and fill the gap and maybe test a new low. That's always a possibility. Right now, I think the probability is that we're going to hang somewhere, around this area, the weekly expected move, the lower end of that. That's where I think we'll probably just end up being. It is possible that we could dip and have a long wick like we did back here, and maybe it end up being a hammer style wick, which would signal a reversal. Those are all probabilities right now. But I think we're going to end up being somewhere around this purple line here as we get to the end of the week. Could we fall gap down tomorrow? That's a possibility. Could it have a long wick on the bottom? It's a possibility. So I think right now our reward to the upside is really, really limited. Our risk to the downside is much, much bigger right now than what our potential upside could be. That's what I think. All right. Well, we'll go ahead and wrap it up here for today. Again, I greatly appreciate you being here, and hopefully we're all learning stuff together as we go along our investor journeys. So that's it for today. I'll be back tomorrow after the markets have closed. And of course, investors, you can catch me on Patreon. Like any investor that hasn't joined us yet there, click the first link in the description. Come check it out. If it's not for you, then it's okay. It's not for you. But I think it is very beneficial. It helps us, through this crazy market. All right. Have a good night, and I will see you in the next one. Take care.